Hello, Warriors. How's everyone doing? Alexander, how are you? Sa, hello. And Brock, how's it going? Ingmar, how's it going? So let's take a look around on this Monday with the dollar a bit weaker. Then I'll bring Brian in here. Hi, Marco. Doing okay. Ryan, how are you, buddy? Okay.
Yeah, hi coach. How you doing?
Good, buddy. So uh, the dollar is either rolling over here or there's one more shot up in my view, Ryan. I look at the euro and I ask myself, aren't they going to take these stops out first? Okay, so we kind of had a false breakout here, and so far this low held. I have to think that there's some kind of you know liquidity that maybe some of the black boxes may look for under here. So actually, the preferred long would be here for me, Ryan. It looks like cables already began its corrective it bounced back to maybe 140. But if euro breaks down, I think I'll have a chance to buy the pound cheaper. Maybe 100 pips or so cheaper. So this, what I'd like to see for a setup would be euro breaking down, heading towards your number. I believe you said 1680 last week, Ryan. And
Next one's 1700, 1690 ish.
oh, okay, okay. So that's still 50 lower from recent lows. And if that happens, I don't think cable will make a new low. It'll set up a higher low. So that's what I'd be looking for. And the last thing would probably be oil kind of sold off yesterday. Um, I'm reassessing. This was, I did some research, and I guess this was a 5 wave advance. So maybe on shorts here, you look for a pullback to 69 to 68, and then look to get long again. So, anything new that you've seen from last night when I was sleeping, Ryan, and going on over
Not
there?
really. We had a little drop in yields again in the
Yeah,
early part of the day, and they since recovered. And really, we've just seen the gyrations in dollar and yen on the back of those mainly.
right.
Yen pairs were a little off this morning, and like Guppy and Euro Yen, and they're back up again. I think we're right into summer markets now, and hesitation ahead of the FOMC.
That's right.
So I'm not seeing any fireworks coming in anytime soon. We're looking at cable just now, and we're nudging that 138 zone, which the last week or so, that's where we found support before the breakdown, and
Oh yeah, right
we're
here.
just we're just tapping on it again without looking like it's going to explode higher. But then you never know with cable. 5 minutes time, it could be through there and trading 138.50.
Yeah, kind of looks
It's
like
really
140 would be kind of a natural place for it, maybe, huh? Well,
Yeah,
here you
we've got a
go.
couple of fairly decent steps there. 140 obviously being a big psychological and on account on various accounts
Yeah,
technical
39.
levels.
Yeah, we're right
39
in
double
between.
O 10. Yeah,
Yeah, right in
39
between
double O
these
10.
two moving averages. So right, that's the number you're talking about. Okay.
Yeah,
All right. Okay. So with the dollar a little softer, metals are trying to pop. Last week you and I talked about this level 1794. Looks like there was some kind of stop hunt here, but it held. It traded underneath it, but did not close underneath it. A close underneath it is, I think, going to be
yeah.
negative. So, but maybe
But the
we
bounces
could,
aren't looking
yeah,
the bounces aren't
cable.
looking too hot in that one, are they?
Um, Silver is even looking, the bounces look even weaker than in
Yeah,
gold. So I don't know that, the conflict is if the dollar has turned for a correction. And, I thought there was a shot for maybe one more high up towards 93 and a half. And you think the dollar is going to sell off maybe to here or so. It's hard to want to be short the metals in that environment. So, even though the charts look messy, do you ever, what do you say to yourself, Ryan, your self talk when, you have a correlation that, normally works, and you see something in a correlated market, that would tell you not to do something, I've kind of learned over the years that you almost have to treat each chart, even though there are relationships, as its own individual entity. And sometimes
Yeah.
when you look at all the correlations, they can throw you off.
Yeah, exactly. I mean, one of the biggest ones that people look at is obviously oil and the Canadian dollar.
Yeah.
And there's times you can see where they're moving correlated, and sometimes you see when they're not. And like you say, people say, oh, there's a strong correlation between CAD and oil. Well, yeah, but if you're looking at oil too much, trying to work out what CAD's doing, you might as well trade oil, and vice versa.
Good point.
You can look too hard at something trying to get something else to move.
Yeah.
But you use these correlations just as a general wind, what's behind a currency. And if you see there's a disparity there, let's say oil's going up and CAD's going down, you think, well, okay, that correlation is not working. So what is driving the CAD price? If it's not oil, and then
yeah, go ahead. I'm sorry.
Yeah, sorry. And then obviously you look at the other side of whatever pair you're looking at. Is it Aussie CAD? Is it dollar CAD? Is it Euro CAD? And you see where the influence is coming from.
Okay. And it also looks like, putting higher lows in the Aussie and Kiwi right here. So maybe the lows are in there too, like they are in cable. I think Euro's the key, whether or not we get one more push down or not. Otherwise, the dollar has entered some type of corrective mode.
Yeah, Aussie's a quite good one. It's you can pretty much look at it from the big figures at the moment. 73, 74, and go with either side. 74 was a big level I've been highlighting for quite a while on the way down. Had one trade off it that was successful, and one that I folded just before it collapsed through. But if we get under 73, 72.90, then really we should be bringing the big 70 level into focus, because that's where the eyeballs are going to go, and that's another big doozy of a level. If we get back above that 74 handle, then again it takes some of the prior pressure off, and we see where it goes up, maybe up to sort of 75.10 again.
Yeah. Okay. Well, thanks for your review. Anything you want to comment on that I didn't ask you about that you had on your mind this morning?
No, I'm just worried that we're hitting summer markets here, and we're going to do a lot of water treading into the FOMC. I mean, we're talking about this. A lot of people talking about this wedge in euro dollar, and I've got a feeling we might just wander out of it sideways without much happening at all. We've got that big solid level at 1750. That's the downside marker, whether you're following the bottom of a wedge or not. But the upside, the top side, we keep sort of walking through the top of the wedge, or the top trend line, which tends to weaken it a bit and make the pattern a bit redundant the longer that happens.
Okay, so we had a false breakout here on the ECB, and maybe we end up having a false breakdown. So they got some of the stops going all the way back to here on ECB day, but they still haven't taken out the sell stop. So we'll see. Call me jaded. I think the market wants to shake out as many longs as possible before we get a pop. So I'm going to try to be patient. If I miss it, I miss it. How do you feel about missing trades, Brian? I do every day. How about you?
Yeah, I mean, the one I'm sort of still kicking myself about was missing the trade down to 109 in dollar yen. That was one of those levels you have on your chart and you're watching. Didn't quite get low enough, so I can't call it that much of a miss. But 07, I like to get in around big figures around 05. So, but if you can't beat yourself up too much if you miss it, and you walk on to the next one.
Another one, isn't there?
Yeah, exactly. There's always plenty of opportunities. Okay. Yeah, it's a good thing with this game.
So, Blake, you want to chime in?
Well, I guess since it's Monday, I guess I should chime in a little bit. How you guys doing?
Good.
I just wanted
to
echo, hey, Ryan, I just wanted to echo Ryan's thoughts. I mean, it is unfortunately summer doldrums. And I have to admit though, this summer has been a little bit more active than normal summers. Sometimes we get a literally 3-month lull between, June, July, and August. So at least we've seen some activity, but really as you head into August, end of July, obviously, into August, that's like vacation month for a lot of Europeans. And from what I've experienced, and Ryan, I'm sure you could speak more to that, but I know just from like our partners here at Forex Analytics, being Greek, they tend to take time off in the month of August. So
sounds like you're pushing for a holiday, Blake.
I wouldn't mind having another one, frankly. It's interesting. My kids actually start school in the next week and a half, so that's what happens over here in the U.S. Anyway, I thought I'd just share with you a couple of things. There was a lot of comments overnight about the Asian markets and they're moving so aggressively. But before you get, you're just all excited about, seeing some risk off in Asia, let's take a quick look at those markets so you can just have a decent view of what's going on. This is the daily chart, this is the daily chart, excuse me, of the Nikkei. Now, if you just take a step back for a second, just realize we're in a bit of a channel. We're hugging the 200-day moving average. And yeah, I mean, we're down a little bit over 1%. And, we're down a little bit. Yes. Is the market like super aggressive here? I don't think so. And could you really just argue that we're in a bit of a channel in a channel? And I would say, yeah, probably. Yeah. So it looks something like this, right? That's realistically where we're at. So then you go, oh, Blake, the Shanghai was down like 2.3%. Obviously, we're seeing a complete meltdown over there. We saw a little bit of a sell-off, but we actually just hit daily trendline support and we bounced actually right off of there. Now, there's been some headlines that are driving some of the Asian markets, but just realize that we haven't really broken down yet. Then you go, well, I see Shanghai, but how about the Hang Seng? Hang Seng's down 4%. Again, we're just closing in on really key support here. So before you get really aggressively short risk or, think the markets are going, they're going to be upended here. I'd just be a little careful. Asian markets have sold off, but we've come to pretty key levels of support. And then, also keep in mind that the S&P is we're still trading above 4,400. I mean, and it's Monday. We like to, but we like to call it over here, mutual fund Monday, right, Dale? I mean, when everybody comes in on Monday and just buys them on Monday, I think if you take every Monday over the last year and a half, that would account for most of the gains. That's what I've seen that breakdown before in the past. So.
Okay. Yeah. Monday follow through from a strong day Friday. I mean, it was a great week. Surprised me, Blake, that I thought we'd had fib retracements after reversal week to the downside and went from, the market getting smashed on Monday to new highs by Friday.
Yeah.
I haven't seen that in a while.
Yeah, I mean, I think it really caught a lot of people off guard. People were probably shorting this break right here on Monday, Tuesday, and getting aggressively bearish or thinking the market's going to roll over, and then they had to chase the markets higher again. I'll tell you, and I said it during the week ahead video. I actually took a loss on a couple of trades that took away some of my gains the last couple of weeks. I was long the dollar Canadian when it dropped through. I started buying it as we were here at 126.60, and then I tried to buy in some more down here at this support, and I ended up taking like a 60 pip loss on my average on the dollar Canadian. This is a 200 pip move intraday. That's a pretty wild move. And then, I took a hickey on the sterling as this had this false breakdown. But yeah, last week, I mean, you thought the equity markets were going to roll over, which, just to,
Well, they
just
rolled
to-
over the week before. You thought you might have a failing rally.
we thought we might get a follow through, right? And I actually I was long dollars into this move, which paid me really well over the last couple of weeks. I just ended up giving back some of the gains because I didn't expect this. I didn't. And then
The
once we
market
started
really ignored a strong dollar for a couple months.
Yeah, but you also have to keep in mind that the dollar was actually the dollar has just been, it's been actually very steady. And
Yeah.
to be honest, I mean, I look at the dollar and it's hard to be bearish the dollar right now. I mean, I understand that we have like the sterling's up against resistance right now at 138. The euro's at wedge resistance. And Ryan was just talking about this wedge. Wouldn't it be something, I don't know if Ryan's here, but wouldn't it be something if we just drifted out of this wedge and just sat sideways? I mean,
Yeah, that's exactly what I was saying about it.
I know, I heard you say it and I'm like, that would be something. That would be typical summer market doldrums. But I think that we have a risk, even if it's just this, Ryan, that we break these highs at 118.20, and we just move up to 118.50 and then we just drift away till FOMC, right?
Yeah, I mean that's exactly what it can do. It can also set us up for a break of that 50 area, travel down to 30, 25, 30 and then come right back again. It's you got to take the vol into consideration. I mean, looking at the vols now, and I look at the 1 month at the money option vols as my general guide.
Yeah.
At the moment, euros at 5.21%. That's threatening to go below 5% when it gets really low.
That's horrible.
Dollar yen's 5.42. But then cable's still elevated up near sevens at 6.84%. So that's why you always get that differential in, euro moves 10 pips, cable moves 25, 30 pips in the same thing.
Yeah, and what Ryan is just if you guys are not familiar with what Ryan's talking about, and just the volatility in the euro when it trades sub 5%, it is really difficult to make money in the markets because it's the volatility is so low. And that's something that that I was really turned on to over the last several years, trading on bigger size, because we would just automatically pare back our size positioning when we started, volatility would fall like that. And, hopefully this week, we get some activity in the FOMC. So let me ask you this, and then I'm going to take Stelios, because I'm assuming he's here this morning. I'm not sure if he's here, but I think
Good morning. I'm
Hey,
here.
he is. Hey, there
Hey, how
he
you
is.
feeling,
Hopefully
Stel?
you're feeling
I'm
better.
good. I'm good today. Yeah, thank you.
Hey, so just in a few minutes, I want to get you guys' opinions on what you think the Fed's going to do today, if they're going to do anything. And I just got to give you my opinion here as far as this Delta variant. My father-in-law, and I meant to tell you this too, Stelios, because I just found this out yesterday. My father-in-law was going to travel to Greece in September, had his tickets and everything, and he's canceling his trip. Now he is a bit older, but his family or friends were telling him that it might, people are starting to have a difficult time getting out of like the country. And he's like, well, I just don't want to risk it. Plus the Delta variant, blah, 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 blah. And there's a lot of risk that's or a lot of talk around this Delta variant. And I'm pretty much in the camp as far as the US goes. We might get a mask mandate here or there, and, people will, or some will or will not abide by it, especially like where I live, people don't really care. But, you take outside of the US, it becomes a little bit more of a risk in different countries where you might start shutting down some things. So I guess my question to you is, will the Fed, my opinion is the Fed's going to reference this, which is going to keep them dovish, which in essence is going to keep stocks elevated, because if the Fed's like, maybe we won't taper just so maybe we'll have to hold our horses just a little bit. Stocks are going to like that, and the dollar's going to get, demolished because of it. So what are your opinions regarding what the Fed's going to do this week? My opinion is they are going to be a little bit more dovish because of, COVID globally.
Who are you asking? You asking me or somebody else?
I was asking somebody in the audience, you guys, of course I'm asking you guys, whoever you want.
My
Whoever wants
opinion,
to answer first.
I pushed the buzzer first. My opinion is that they will want to find reasons to delay. They always do. So I think your point is very valid, and if there is any excuse for them to be a little bit more on the dovish side, they're going to do it. Even as inflation is going higher, I was looking at the chart of the shipping container rates. Have you seen that? It's just
I haven't.
The guy at Bloomberg tweeted it. It's just a straight line higher. I've told you before, I have a couple of ship owner friends, and they're telling me it's like the best days of their lives. It's incredible. So this is not going down anytime soon. So you have inflation everywhere. So the central banks are under pressure, but they keep persisting with a transitory language, and they're going to do that. They're going to continue doing that until they can do no more. So I'm with you. I think if they can find an excuse to be a bit more dovish, they're going to be a bit more dovish. The problem is there are not too many excuses now out there, the Delta variant being one of them. So it's a tough one. Theoretically, the Fed should already be moving, and they're not. So what do they do this week?
They're gonna keep this merry-go-round going. So what do you think, Ryan?
Yeah, I'm a bit different when it comes to thinking about the Fed, and not to knock what Stellis is saying, but the central banks don't want to be dovish for the sake of being dovish. They want the economy to recover. They want jobs to recover. They'd rather have rates higher. That was proved when we came out of the last crisis. The Fed were one of the strongest in moving their rates up because they knew they needed the margin to, if something else hit the fan. But regarding this meeting, I think it's going to be neutral. I think it's going to be the usual. Inflation's transitory. We're ready to do as much as we need to do, but we don't need to really be dovish because we're waiting and seeing what's happening with inflation and the economy. Yeah, the virus is still an issue. They're going to mention that, and that keeps the risk side in play. But I don't think they're going to be overly dovish. I think it's a neutral can kick, if you like, because we've got Jackson Hole coming up, and they've got one eye on what happens when all the job support ends and trying to get workers back in the workforce. That's their key point. And as we learned from the last FOMC, or some of the last talks that Powell gave, he switched it a bit onto jobs. Everyone's looking at inflation, saying, yeah, inflation's high. What if it's not transitory, blah, blah, blah. And he just turned around basically and said, oh yeah, don't forget, we also look at jobs. That's on the mandate, and that's just as important. And so obviously we've got the NFP next week, jobs report next week. So I think this is going to be nothing more than a can kick into the September meeting. Obviously, the market will then focus on Jackson Hole in August.
Yeah, no, what we've seen, and thanks for your opinions, guys. What we've seen, this is the daily chart of like the 10-year, just to reference it. We've seen this sell off in yields, and Stelios, you've been pretty much an advocate of, the markets aren't really going to ever sell off unless we start to see yields higher. But I'm looking at the 10-year, and it's been trading heavy, over the last, I guess the last few weeks. So what do you guys think about yields here? I mean, is this a place where we should be selling bonds? What do you guys think?
I personally have said it before. I want to be short treasuries and bonds. Not pulling the trigger yet. Bonds, my targets, selling targets around 177.5. There's a resistance trend line where that comes around there. The way I drew it on the daily, I don't have the chart right now, but that's where I remember it. And treasuries as well. I mean, at some point, something's got to give, right? So either inflation has to go way down or yields have to go up. I think yields are just too low. And given the fact that we are going to eventually see tapering and maybe rate hikes and all that, they just can't keep hovering around 1 or 1.5%. 10-year US forever. It's been a very difficult trade to be short treasuries. I haven't been short treasuries. I was short bunds for a while. It went well, but people who have been short treasuries just have got burned for the last weeks, months. So it's a very difficult trade. I want to be short, but I'm not short quite yet. I will obviously let everybody know in the chat room when I do short them.
All right. Well, Ryan, what do you think about yields here? I mean, do you think that do you think there's a trade here? I mean, Stelios wants to be short like the 10-year, and I get what he's saying. I get that, something's got to give, and obviously the Fed thinks it's inflation that's going to give, but will yields have to go up? Do you short bonds? I mean, look at the 10-year. I mean, the 10-year is right up at the 200-day moving average. Is this like just a glaring opportunity to be short bonds and long yields, or do they continue to trade up and yields slump again? And maybe inflation comes down. What do you think?
Yeah, I mean, the yield move down has been quite surprising, because that's not what happens when you've got in a recovery phase. Coming off a shock like we have. I mean, we saw obviously the bond yields rising as we came through the early part of the year, and that was all like, well, okay, that's great, that's what I'm expecting. Get up towards that 2% mark. Maybe we hover sort of 1.52% until we know what the Fed's going to do. But the drop all the way down, the sub 120. That's, to me, is quite shocking, and it smells like someone's having a play on maybe the next year, and maybe that the recoveries aren't going to be as strong as expected, or that we're going to see a knee-jerk recovery as the virus effect wanes. But then from that point onwards, stagflation is a big talking point and one of our big risks for next year. And you get to wonder whether the market is just positioning for that a bit, hence why we're seeing a run into these bonds. But the big clue will come when the Fed decide to taper, when they indicate they're going to decide to taper, is what yields do then. I think shorts are going to be the play. I wouldn't look to short here because we're a bit in the middle of this last recent move. But if we get another move sub, 1.2, 1.5% in tens, maybe down towards the recent lows in yields, that's the area to look at.
Yeah.
If that support holds again, then that's when you pile in.
All right. Well, thanks for your opinion, guys. And before I allow Coach to take over, I want to just mention, Ben said, "Hey, if you don't believe inflation's here, check out coffee. Central banks are playing whack-a-mole with inflation now. It keeps popping up in different commodities. It does, and that's something definitely you got to be looking at. I mean, obviously you could take a look at lumber and see what's happened here. It's very similar moves in a lot of different commodities. One of the things that just maybe it's me and the time that I've been in the markets, and maybe Stelios and Ryan might feel the same. I'm really watching precious metals, because precious metals have been underperforming. And I mean, if you believe that inflation's here, or you believe that it's coming, I would think it's got to show up in A, it's got to show up in yields. B, it's got to show up in precious metals. And we're just not seeing it. And we're seeing these different commodities percolating, but maybe the Fed is right. I mean, maybe the Fed is right and it is all transitory. I guess we'll soon see. And, I think that this fall is going to be very interesting. And Ryan, you said the S word. I actually have a joke for you guys. Yeah. I'm going to tell you what the S word is. I was in the car with my kids. They were, at the time, this is probably about 10 years ago. They're like, 5 and 7. And my youngest son goes, Blake, Dad, I'm not gonna be friends with Joey. I'm like, what? Why are you not gonna be friends with Joey? He said, well, he keeps saying the S word. And I'm like, oh, sometimes kids just use bad language just because they're having a hard time describing how they feel. And, and he's like, well, is the S word a bad word? And I'm like, Yeah, it's a bad word. You don't have just a word though. You don't have to use it. And then my other son, the older one, he looks at me and he goes, "Dad," or he goes, what does the S word mean?" And I said, "Well, it means poop." And then my older son goes, "Wait, shoot means poop?" Get it? That's not the S word. Anyway, but Ryan used the stagflation, and that's a true story, by the way. Stagflation comments, and I know that's a really nasty word when you're talking about economies moving forward. Hey guys, I just, especially the global economy. Hey guys, I just want to mention, if you haven't tried out Forex Analytics, you've heard Ryan here. Ryan's from Forex Flow Live. He is him and his team have joined us over at Forex Analytics. Therefore, we have a buy 1 month, get 1 month free for our premium plan. And then we have semi-annual and annual discounts that are available to you. We only leave these pricing discounts up for a short period of time. And so take advantage of them, because we haven't put it out since the beginning of the year. So you guys might have to wait another 6 months before you get special pricing. If you've been waiting to be part of this family and all of us here at Forex Analytics, then we'll see you there. Take advantage of the prices. All right, Dale, it's all yours. Have a great interview.
Thank you, Blake. Good hunting today. Thank you,
Thanks, guys.
Ryan, Stelios.
Cheers, guys.
Thanks, guys.
Thank you guys for a little bit of a market feel coming into a new week. And Tim, I want to welcome you back to Face. How are you?
Hey, Dale, I'm good. Thank you. You?
Good, doing okay, Tim. So macrodesiac almost sounds like aphrodisiac. Was that a play on words for you guys, for you with your handle?
It definitely was. Yeah, it was supposed to be a love of macro. It was somewhere.
Okay, beautiful. All right. Well, I like telescopes. I think a lot of people get carried away with their microscope, get too short term. So if you recall how to share a screen, we could take a look at what you have on your radar and if anything's changed since our last conversation. So, okay, a new way to visualize the surge in COVID.
Yeah, it's something that I'm noticing a lot. That it's something we've been talking about. Is this the sort of potential for policymakers to kind of not evolve with the times? When we're looking at these sort of case numbers and everything here, and we're seeing the things that have been reported and some of the things that are coming up in the press conferences, they're still very heavily focused on the cases, as if that's the thing that they're gonna respond to. And obviously I know it seems to be quite political in the US, especially
Yes.
as the vaccination, who's
Right.
vaccinated, which party they're affiliated with and everything else. But then when you go across to some of the data that's been around lately that I've got here, okay, I'll take this from the FT piece recently. You see the way, I think this one actually shows it the best. I think this was.
Oh yeah, I think I saw that other one. Retweeted it, the one
This one?
before this. Yeah.
Yeah, that's it. You see the difference that we need to sort of look at now, I think, is obviously the fact that we're moving into a new regime within the virus itself. Obviously, we're seeing now that it's more about hospitalizations, it's more about deaths, and that the vaccination doesn't stop people from catching COVID. That's the big thing that we're sort of seeing. It doesn't stop it at all. It's not intended to. And there's a risk that obviously policymakers are going to overreact to this, and start putting in lockdowns again. And there's a lot of uncertainty around, I think. Are you noticing
isn't
that too?
Australia the only country so far? Except I heard that China went into lockdown. But
yeah, I think one of their cities, just one of their cities again.
okay, they're always. I mean, that's not a new. Their whole country's locked down by their political party. So, you think it could be a policy error here?
Yeah, I think definitely. I think there's the potential for some governments to overreact to case numbers, and not necessarily put us back into lockdowns, but just make everything drag more. And Australia is obviously the exception because they just they took laid back to a whole new level there with their approach to getting the vaccines. So, but yeah, I really think that's a potential there. You've seen the coverage of it, and policymakers are worried about things. But in the background, a couple of things are happening. We saw Italy have extended their state of emergency until the end of the year. but they're not
Wow.
now. But they've linked the restrictions to hospitalizations rather than actually linking them to the case numbers. So it's kind of it is an evolution, but it didn't really get much coverage.
Okay.
So, but yeah, Australia, we're one of the things we're looking at in particular is obviously just into sorry, I've got the pound dollar chart there. Get the GBP AUD is the potential for another vaccine trade. We had on last time, I think actually around the last time I came on, we played the euro against the pound for the sort of relative vaccination rate trade, and now we're looking at pound Aussie for exactly that same trade, and it's obviously you can see it's broken out here on the daily chart just at this area here.
Interesting.
I think it's one of those. A lot of these crosses kind of go under the radar all the time, but at the moment with the risk environment we're in, it makes sense to potentially play, some of the among the G10, shall we say, the higher beta currencies against each other along other lines rather than playing sort of, Aussie yen, for example, was the classic risk on, risk off. But I had a little dabble in that earlier today, and it didn't go well. So
what a creative approach to you're the first one I've talked to about kind of singling out countries and policies and based on COVID response, meaning the ones with a more serious response are going to have less economic growth compared to the ones that do not have draconian measures in place. A very creative way to look at FX.
Yeah, I think you kind of thank you, and I think we're kind of forced into it a little bit as well because there's no real monetary policy differentials to play off against each other now. So you've got to look at the fiscal environment and the economic environment a bit more than you traditionally would because there just isn't the interest rate differential at the moment.
Okay. Well, there's some talk among our team today, with the Fed meeting this week, that maybe they could take advantage of, a bit of the overreaction to what's happening with the Delta variant and, kind of build its case for staying dovish longer. What are your expectations from the Fed?
Absolutely. I think that's going to be, they're certainly not going to be any more hawkish than they were perceived last time. That's for sure. Because I think really last time, if you actually listen to particularly Powell's comments in the press conference afterwards, he wasn't really saying that much that was any different to prior press conferences. There was a couple of things that were sort of, slightly more optimistic because obviously things had progressed, but, there was still a lot of focus on unemployment and, he's still very much in the transitory camp as far as inflation goes. But I think really the dots stole the show last time. And obviously they're dealing with a lot of uncertainty, as we all are at the moment, about the future path of everything. So it's very difficult. No, I don't like it either. I don't like it. It's tough to hold on to anything at all.
It's hard to be positive.
Yeah, very, very.
Really tough. I guess you don't know if you have faith till you need it.
I guess not.
Right, buddy? Anyway, you could say, oh gosh, I have strong faith. And then you have a little crisis and you're going, Mom. Anyway, so
those markets,
that's pretty interesting, the way you're looking at this. So you just see a continuation of this inflation debate, transient, sticky. You have any feel on yields? I seem last week's action in the 10-year looks like it may have ended the recent fall in yields at the 113 level. You have that's a big debate here. What's the next move in yields? Well, from 178 it was down, but I'm thinking from here we start heading up over time. You have any feel for that?
Yes and no. Again, I'm very, very conflicted at the moment with a lot of things that are going on. We've been having a chat at Macrodesiac about what's actually been driving the yields and sort of how much should I say, shouldn't be attributed to the inflation side of the story, and perhaps how much should be attributed more to the China slowdown and more recently these China regulations that have been weighing on everything, particularly overnight. We're wondering sort of more whether the bonds it's the flights to safety, the flights to quality, that's actually driving it more than the inflation story, or at least as much as the inflation story.
Good
So
point.
it looks to me like there's still a decent camp of people that want to move into the kind of cyclical part of the cycle. You know, they want to move on now from this initial sort of recovery phase into expansion. They want to get into the next sort of phase of growth. But I think there's
Right.
still just potentially too much. There's a lot of factors that still need to be resolved before you can do that with any degree of confidence, I think. So I think yields are probably going to be choppy. I don't know that we'll see much lower than we have seen now, unless we get a real bout of sudden risk aversion again. But at the same time, I'm not expecting them to shoot up to, the 10-year up to 2% this year or anything else. I just think we're gonna have a lot of false starts. Unfortunately, I feel that feels to me like the way things are gonna go. With the virus, with supply chains, with we're still gonna get some of the inflation story now. It's been used cars recently. That's obviously that
I never thought that would happen.
No, it's crazy, but it just shows how you can't trust the data. You've got to dig into the data. Really try and look beyond, underneath it, rather than just trying to say, oh, inflation's going up, therefore, or this is happening, therefore. You've got to look beyond that, the sort of second order, third order consequences, what's going on underneath. For example, now the next sort of thing, now used cars looks like it's probably going to resolve itself. The chips are coming back on as well, so new car supply is going to come back online. That will move out of it, but now we're going to move on to the rental side of things. The owner equivalent rents, that's going to be a key part of the inflation picture now, how much people are paying to rent property. And again, there's a lot of people that are drawing a correlation between the price of houses, which has obviously gone up exponentially during the whole crisis, and what rental prices will be. And there has definitely been an increase in what people are asking for rents. But at the same time, I don't think rents are necessarily linked to the housing prices. I think they're more linked to wage prices. Obviously, the more you can earn, the more you pay in rent, and especially now you've potentially got more of an option to work remotely. Why would you stick around somewhere necessarily where you've got to pay a fortune for rent if you can go and work remotely somewhere else?
True. Okay, so yeah, I'm getting a question and a little bit of a debate from a few of our attendees. With such low yields, Tim, how do you explain that gold is not rallying? What's going on?
If I'm completely honest, I can't. All right.
You don't know. All right.
It's puzzled. I've got the chart. I've got the chart right here. Okay, let's have a look. Okay, there. Yeah. You see that there on the screen. So what I've done there. Okay, so you get your real yield up there,
right,
and you've got your gold price here. So in theory, as we saw over here, all right, at this kind of level of negative yields, negative real yields, gold should be much higher, but it's not. Okay, now that kind of says to me that we're not. Because gold obviously it's a hedge against negative real yields, it's a hedge against negative nominal yields as well. It's a zero yielding asset, somewhere to put money that's just going to, roughly speaking, hold value. That's the general idea. So I can't really explain why this is broken down here, other than the idea that perhaps people are expecting the orange line to come back down, that we're going to get these higher yields again at some point, and yields will go less negative. That's all that I can think to explain it, because if we're really moving into a low inflation, low growth environment, then gold should be higher.
Okay. And the recent, we've had some pretty volatile action after a sustained bull move in WTI. And it came off about, I don't know, $10, $12 from the high, and then recovered more than half in a matter of days, but still not making a higher high. This could be the second lower high. Where do you come down on energy?
I think that what we've got at the moment, again, it's very, very messy, but potentially we've got an undersupplied market in the short term. Then we've got potentially an oversupplied market next year, perhaps as all of the if they try and bring back all of their pre-COVID production next year, which is currently the plan throughout 2022. But then beyond that, it's a case that our energy needs keep on going up. This sort of the idea of this energy transition. I think it's again, people get you've got to really zoom out with it and look and see what are the alternatives that are going to replace oil over a short time frame, and then they're not really scalable yet to get that amount of power online quickly enough that we're not going to see higher energy prices, I think, going forward in the short term. especially while everyone's so averse to nuclear, which, in terms of the policy making circles, it just still amazes me really. There's some really fabulous things going on with nuclear fusion now. They think they might have actually solved the science side of it with these high powered magnets. So it looks like nuclear fusion could be very safe and could give us almost an abundance of energy that we never dreamed of. And really
uranium.
Uranium, yeah. And there was what's the other one? Oh, I always forget this one. It hasn't been spoken about much. I think it's thorium, if I remember rightly.
Okay.
It's another type that I was reading about recently. I don't profess to be an expert in any of these things. I just sort of try and dip a finger in a lot of pies to get a good idea of what the overall playing field is.
Okay, how about the playing field? I thought it was remarkable how we had a reversal week the week before, and stock indexes came in sharply lower and then made new highs by the end of the week, becoming, parabolic. I thought we'd have a retracement move off that break, but here we are at new highs. So just continue this continuation of this bull market that will not cave. We haven't had a 5% correction, and I think I was reading 14 months or something like that.
Yeah, that sounds about right. And yeah, again, it's a shortage of good quality assets. So what we always see is especially when I suppose if you think about the big tech stocks, which are obviously the ones that are most heavily weighted in the Nasdaq and the S&P,
and leading the way.
Yeah, they are just somewhere that you can always put money when, again, you've got low yielding bonds and everything else there. They're the ones that are driving the earnings. They're the ones that are driving pretty much everything. And if you don't want to put your money into bonds, then which stocks do you go to? Well, you always go to those first. And obviously they're heavily weighted in the indices, so obviously indices are going to keep on going higher. I think there is the potential at some point, once we kind of muddle through this next period, where there's been a lot of talk about moving into the mid-cycle. All right, so transitioning into the mid-cycle. I think Morgan Stanley have been talking about this for 2 or 3, maybe a bit longer than 2 or 3 months now. Perhaps we move more into capex and that area of sort of spending, and the growth will come in other stocks. And obviously the high weighting might work against the indices there for a little while. Morgan Stanley are actually talking about a 10 to 20% pullback on that. I'm not sure that we'll get that deep, to be honest. I think buy the dip is so ingrained now that even a 5% dip looks like a gift. So yeah, I don't really see us. I don't see anything, because it's just the shortage of assets. Where else do you put your money? It's a constant question. No one can offer another answer for. I mean, you can't even put it in China at the moment, because you're just going to lose money.
Can we really have it both ways? I remember back in 2008, and 9, when we were going through the housing crisis.
Mhm.
China wasn't. Europe was. Europe was affected by what happened here. We were the epicenter. And the talk was, China's still growing. They're going to help pull us out of this recession because they still have growth.
Mhm.
So can we have it both ways, where, China is not leading the way now? And there are a lot of draconian things happening there with stocks and lending and credit. And if China could pull us out of an economic malaise, could it pull us into one?
Yeah, I mean, arguably now the boot's on the other foot now, isn't it? China
Yeah.
actually needs the West to pull them out of economic malaise. Really, there's a lot of stuff that goes on with their numbers, as we all know, that they're not to be relied on. But their economy isn't strong, across the board, and they're really struggling to get their consumption up as well. They're trying to move to that dual circulation economy.
Yeah, that handoff didn't really happen, did it? With
No.
From being an export economy to being a consumer-led economy.
No, not at all. Not at all. So
Okay.
I think they actually, they're definitely not going to be the ones to pull us out of it. And like you say, they may well end up pulling us into it.
Because you look at charts from FXI and some of the Asian markets, it's night and day compared to the US markets.
Yeah, completely. I mean, in some of these education stocks, they're down like 70, 80% in a matter of days.
Well, well, that's an education.
Yeah, it
For
certainly was.
anyone who
But,
bought
yeah,
those, you know,
exactly.
risk, that's an expensive one. Not that I have never experienced it. I know it's expensive because I have experienced it. So, really appreciate you coming in and sharing your views. I think very creative of, you know, using what's happening in the world to construct of FX trades. And, you know, another great interview. Thank you, Tim.
Thanks, Dale. My pleasure.
And why don't you show people your website if you like, and how they could follow you? I see you have some type of free newsletter,
Yep,
and
yep.
you're with Peter Bell. You guys are partners, correct?
David Bell.
David Bell. Okay,
Yes.
okay. You're with
Yeah.
David, and there you go.
Yeah, that's it. So you
Marketing.
find us at macrodesiac.com or at macrodesiac on Twitter as well, or you can follow David. David, you can find him at David Bell, and I'm at Volatim.
Tim, thank you so much, my trading warrior brother, for coming in. And you know, I've only talked to you, interviewed you a couple times, but I learned from you each time. And
Likewise. Thank you, Dave.
I
Thank you.
appreciate you edifying our faith community here today, my friend. Thank you.
Thanks, mate. Pleasure.
Okay, everyone, that's a wrap. We'll see everyone for Turnaround Tuesday. Good trading. You're welcome, Ingmar. People are thanking us, Tim, for the interview.
Excellent.
And remember, don't just count your
Thanks, guys.
viruses, count your blessings. So anyway, guys, I'll see I'll see everyone tomorrow. Thank you,
Cheers,
Brad.
guys.
All
Bye.
right, see you, Tim. Adios.